Swati, hi, good morning. The clear talking point for
Yeah.
the market over the last few days in terms of fund flows has been the selling from FIIs and buying by all the domestic, institutions. What's the sense you're getting? Has retail been putting more money in this correction, or have you started to see a bit of redemption pressure?
Well, we have seen flows in last few days. They continue as they were. Of course, the redemptions are not yet seen, and I think probably the fact that everybody talks about that India is relatively better, and also in terms of the overall allocation to financial savings, in terms of the household savings pie. Has also, over the last 3-4 years has gone down in favor of physical savings like real estate and gold. So there is probably a driver in the medium term that the financial savings portion of the household savings is likely to go up from below 35% now to about 40-45% is what is expected. So I think that trend is what we see, and the current retail actions seem to support that. There is clearly volatility in the real estate prices in terms of the transactions not taking place, or the primary research that we did some time back suggested that the price correction actually is evident and inventory is building up. So we see these clear trends of, supporting the overall medium outlook that the financial saving pie has to grow.
Hi Swati, good morning. So would you deploy the money that you have as a house right now in this correction at levels of 7,800, 7,900, or would you prefer to wait it out till the volatility subsides, even if it takes the next few months? Do you have the conviction to deploy money at current levels?
So I think for us it's a business of investing, and that goes on, and volatility really doesn't deter us from investing regularly. But surely the pace of investment gathers when we get such opportunity of bargain picking, and that is what is usually happening. We had been saying that we are looking at some of the sectors which we are underweight, and we would look to add during this volatile period to these sectors.
Okay, so tell us 3 or 4 key sectors that you think your retail investors can buy fresh. I'm sure you would not want to talk individual stocks, but if you could give some sense of the kind of stocks that you would be comfortable buying right now.
So I would say, Anuj, that probably retail investors should always look at a diversified approach, because they wouldn't have the kind of resources that we could deploy in deciding on the sector investments as such. Having said that, the cyclical bias that we have kept continues. Like for example, we are overweight in auto, cement, and also industrial manufacturing. The thought process is that the consumption which was supporting the economic growth so far will be overtaken by investment side of the economy in the next about 18 months to 2 years time, and we have to position our portfolios to take care of that. So that is the thought process. Auto, cement and industrial manufacturing are the overweight positions right now. Also, we will have to look at the defensive consideration in the portfolio, and that is being done by strategic investments in IT and pharmaceuticals at this point of time.
Swati, what would your view be on the markets per se in the near term as well as in the medium term?
So we think that given the inflation and the current account deficit situation, or overall the macroeconomic improvements that we have seen, that side of the economy, probably the investors are looking for a cyclical upturn and the earnings recovery that we are expecting in the second half of FY16. And we think that the earnings trigger could come in FY16, and that is why markets could look at some growth in the medium term in terms of the valuation expanding, and as the of course that has to be preceded by the earnings growth expansion as such, but clearly we could make that case if the earnings growth is back on the track. In the meanwhile, we expect the markets to be range bound, and the valuations are not likely to expand till we see earnings momentum pick up.
Okay, Swati, what is the biggest risk to this market? We've seen a brutal correction. I mean, the biggest correction of the current bull cycle. What is the risk that this is not just a correction, but I mean a bigger correction, maybe a 20-25% correction, and what could be triggered for that?
I think this kind of correction, at least personally, I don't expect that the correction could be that severe. But when you're talking about the risk, we have to understand that we are not in isolation. We have a fair amount of investors, influence coming from foreign portfolio investors, and they probably are taking a view based on the macro calls, and emerging markets per se is perceived as a risky asset, and hence even if the growth is there in emerging markets and particularly in India, it could be susceptible to macro call taken by few FII investors, and that kind of volatility cannot be ruled out. So that the first risk is on the global front, the liquidity flows getting diverted to developed markets. Second risk, I think at this point of time, is the deflation related risk that the world is fighting to see inflation, and that is what is probably holding back the US monetary policy action. So that is one thing which we will have to be cognizant about, and I think apart from that, I wouldn't say, given the current scenario, probably the risk on the crude front seems to be very little, but yes, that is one of the important factors that we should be watching for, as India imports large part of its consumption of crude. So that is the risk on the unveil.
Okay, Swati, we'll leave it at that. Thanks so much for joining in. So that's the UTI Mutual Fund view. They expect markets to remain range-bound, but earnings will pick up towards the end of F516, and that perhaps should drive some momentum for our own equity markets. We will slip into a very short break. We'll come back, and on our corporate radar, we'll be joined by SL Narayanan, the Group CFO of Sun TV.